It's difficult to estimate. I mean, we've got the volumes from the Department of Health. If you multiply the volumes by the best prices in the world, which are on their website, one could come up with anywhere between 5 and 7 billion rands over 2 years. So divide that by 2, somewhere between, let's say, 3 to 4 billion rand a year. If Adcock just gets some kind of slice of that, albeit at very low margin, it will help to create jobs. It will help to fill the factories that we've invested in and give us hopefully some overhead recovery, which will spill over into the rest of our products.
So when it comes to, for example, the gross profit margin, which was down to 45.5%, you also had that operating profit margin falling back. Are you likely to be able to start seeing that increasing once again next year?
That's mostly contingent on the active pharmaceutical ingredients that we purchase from offshore. So if you take a typical pharmaceutical factory, between 60 and 80% of the input costs are driven by dollar-denominated active pharmaceutical ingredient. So with the rand where it is today, it's unlikely that we're going to see too much improvement in that margin. If the rand rallies and things get a bit better than API prices come down, then naturally we should see a widening of the margin. But at the moment, no, I'm not particularly bullish on margins recovering at all in the coming year.
Mm-hmm. So let's talk about achieving this organic volume growth, because as you said, the Nutri-Leader acquisition really brought on the revenue growth, turnover growth that we saw in this period. If it wasn't for that, you might have seen arguably profits or revenue falling back. Yeah. So how are you going to achieve volume growth now? Which product categories from your existing platform are you most optimistic on?
Well, I think if we look at the three main portfolios, if we look at the hospital products portfolio, we've actually still showing good organic growth there. So in the last year, that's been 5% volume growth, offset in fact by price deflation. So we've had a very aggressive competitive set, and we've had some quite restrictive formularies from the medical aids and from the big private hospitals, obviously driving their costs down as well. So it's been very difficult once again to pass price on. That critical care factory is a big water plant, so huge volumes of water, lots of energy use. So once again, utility costs have really affected that. But I think we'll continue to see good volume growth. We've also won about 85% of the public sector tenders, so some good traction in the critical care tenders. In the prescription side of the business, more multinational partnerships. So Lundbeck we signed on recently, that's about another 80 million rands worth of turnover, and there's additional multinationals coming down the line where we will co-promote for them, we'll do distribution, hopefully in time manufacture. And also in that prescription segment, we've grown tenders again. So the tender wins in the public sector, just in tablets and capsules, are 3 times what they were historically. So once again, good volume growth there for the coming year. And then in the OTC business, that's probably the area where we have least control over really how the consumer's feeling. So if the consumer starts to spend more, then certainly we will see an improvement in the OTC business. There again, I think our supply issues will hopefully be a thing of the past. As with bringing on the Nutri-Leader business, it's been a bit of a challenge to get some of the third-party suppliers to give us the requisite service levels, but I think that's now sorted out. So good volume growth in the OTC business as well.
Now, one of the criticisms has been that Adcock has lagged when it comes to international expansion. So what are your plans right now? You've said you're targeting acquisitions in international markets, whether it be businesses or buying up brands, but specifically emerging markets are your focus right now, high growth emerging markets. So how much have you set aside for that?
Yeah, we're still relatively ungeared. I think post-Cosme we should have about 600 million rands worth of debt, so not a huge amount. The business can gear to at least 2.5 times EBITDA, we believe comfortably, maybe even 3 times. So we're still on the outlook for some good acquisitions. A large portion of our investment and cash has been spent on the capital investment that we've done in our supply chain in the last couple of years. But certainly we're still on the outlook for good acquisitions in other emerging markets. I think it's important to say that we're a widely held share. I think we have a relatively more conservative board in terms of making largish acquisitions. So don't expect us to come out of the blocks with multi-billion-dollar type acquisitions, but we'll certainly continue to build our infrastructure in the rest of Africa. And acquisitions there, 100 to 200 million rand, possibly a few more in India of a similar scale that we've done.
So then talk to us about your plans then in Africa, because we saw flat growth. There were some specific problems during the year, counterfeit problems, bottlenecks in the production supply chain. But what are your strategic plans to now grow that top line in Africa?
Yeah, look, Africa's not for sissies, as they say. It's a difficult place, sometimes quite high risk when we've seen some counterfeiting of some of our products, particularly like beta pain in Kenya. We had some production issues out of the Ghanaian factory with just getting clean water, in fact, to the factory that clogged up all of the reverse osmosis plants that we've had. All of that's now been fixed. And, I think certainly we're in a much stronger position, at least in Kenya and Ghana. The challenge now is to find other African countries to go into. The key challenge for us has been Nigeria. We're still very interested in looking for acquisitions in Nigeria. We haven't found one that fulfills the criteria that we've been looking for. So we've opened our own office and are starting our own registrations. In Zimbabwe, we have DAT Labs, which was a 50% joint venture with Tiger Brands. We're looking at taking over the balance of that as well. So hopefully in time, we'll become the partner of choice for multinationals in the rest of Africa. That really is part of what we're trying to do in creating a distribution platform, a sales and marketing infrastructure, and some factory capacity in the rest of Africa. But I think it's a long journey. It's not without risk, and sometimes the rewards over time will hopefully be big.
Just one last question, just going back to your comment around the Conservative board. Do you think that being conservative, being a little bit more prudent is the right approach to have right now?
Well, I think in this economic climate, and given the capital investment that we've had, which has been, it'll be close to 2 billion rands that's been invested in the business, I think the board has been wise to be conservative in making sure that there are adequate cash flows to fund the capital investment and to make sure that we are well positioned, that when we have fully reinvigorated our supply chain and we do then go out and make large acquisitions, we're in a position to have good synergies. It's pointless just going out and spending money and then not having the synergies in your supply chain. So getting the supply chain right, I think, has been the right call.